Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duke Ong with Tri-City Acre Group. With me is my co-host, Steve Fierros.
Yeah, aloha, everyone. Yeah, we had a great interview today with Kevin Dugan with Altus Investments. So Kevin was sharing with us a little bit about what him and his company have got going on. They do turnkey investments, both in the single-family space. He's also a syndicator as well. They're actively working on a project in San Antonio right now. So Kevin definitely shared with us some gems and some drops of knowledge with us about his experience in investing and his desire to want to pay things forward, help others who are trying to better their financial situation. So make sure you get your notepad ready make sure to listen to the episode and I think you'll enjoy it.
Kevin is the CEO of Altus Investment Group, where he has built a vertically integrated investment firm, including investment, property management, and general contracting. He also co-founded MultifamilyMasters.com, a multifamily meetup group with over 3,000 members and 50 locations around the world. Kevin, welcome to the show.
Appreciate it, guys. Pleasure to be here today.
So for those who aren't familiar, tell us a little bit more about what you do and what you're working on now.
For sure. So I'm a full-time real estate investor, left the W-2 job back in September of last year to run the company full-time. And, it's typical bootstrap W-2. So I had a technology job, transitioned over and, integrated into a couple of different projects. But the core business is Section 8 based residential turnkey investments. And then I'm involved in multifamily syndication as well.
Awesome.
Yep.
So what is your why for building passive cash flow?
So like myself, and I'm sure many others, Rich Dad Poor Dad was kind of the beginning of my entrepreneurial endeavors. And it's evolved over time, but ultimately it comes down to contribution and helping out as many people as possible and educating and providing a resource as well as a vehicle that others can invest in and potentially learn and do it themselves. So for me, it really comes down to bringing more value to as many people as possible.
Great. So how do you like to give back?
In terms of giving back, one is education. So paying it forward. And I've lived through and I've worked through a lot of challenges in the real estate side. So when individuals approach me, I really take an overall approach to give them advice as to, what their goals are and, to see if that fits in what they're planning to do. And, I'm an investment advocate. So I believe that everybody should be investing all the time. It's good to diversify. Stock markets can be a little bit unpredictable, but real estate really has a lot of benefits of the ability to increase the value of the property and then collect that monthly cash flow or apply forced appreciation in the multifamily side of things.
Yeah, I completely agree. So let's go back to the first deal that you did as a GP. How did you find it and structure it?
For sure. Yeah. So in terms of the multifamily side of things, the GP, it's a really tight community here on the multifamily side. So, what you start to realize is there's a lot of different aspects to the profession where you can kind of put in your energy and efforts and create value from it. So, I was able to find some really strong operators in San Antonio and, utilize some of my skills to apply some of the due diligence, relationship building, and build that trust to be able to gain some of the partnership in that project. The bulk of the deals, on the GP side that I'm involved in are on the turnkey residential, and with that aspect, it's direct ownership. So we do have some small fund structures, but a lot of it's just 100% ownership with those types of investments.
Okay, so for the syndication side, you mentioned a San Antonio deal. Can you tell me more about that?
For sure. A lot of what we end up doing is trying to find a value add type project. So a B or C class property, it's a little bit dated. The finishes aren't quite where it needs to be. And, it needs some love and care. So you can kind of come in there, improve the units, really improve the exterior by like fresh paint and kind of a vibrant energy so that the community really kind of buys into the fact that the property is changing around. And B and C class properties really lend itself to that aspect because, they're typically older in the 70s, 60s, 70s. The kitchens are dated, so maybe they don't have like new appliances or new paneling or new countertops, and then the bathrooms same are kind of dated. So all of those aspects lead to, when a person goes to rent the place, that they just don't want to pay that premium that you would for, a B plus or an A class product. And we absolutely love, especially the B class right now because it's kind of in the middle. A's are dropping down, C's maybe dropping down, are kind of, a little bit iffy in terms of their income. So the B class product is really what we favor.
Yeah, that makes a lot of sense. We have a similar model there. So what challenges did you overcome in that deal?
So in terms of some of the challenges that we're kind of facing is really just management. That's one of those aspects where you can vet your third-party management company really, really well. At the same time, it's a challenging position to be in because those third-party management companies, it's absolutely critical to the performance of your investment. But if you have your on-site manager that kind of shifts their priorities or is going through challenges in life, they may drop the ball in terms of your value add strategy. So we've elected to bring some of the in-house management, so basically become a little bit more vertically integrated from that aspect. And really our management company that we were using before, they were just going through some struggles. So it's not a knock on them. It's just, this environment's especially challenging. Managers typically have to communicate a lot more. You really need to understand what's going on with your tenant base and resident base so that you can be sympathetic, but also be stern and understanding to make sure that collections are on time.
Yeah, that makes sense. So how is your portfolio performing in the current environment?
It's doing fairly well. So, on the turnkey residential side, money is being paid by the government. So, it's government-sponsored rent, and these individuals have been on tough times. So, usually single-family mothers or elderlies with some sort of disabilities, and the government's paying the majority of their rent. So, that side of the portfolio is doing quite well. In terms of the multifamily side, we're in a Texas market in San Antonio, and it's performing pretty solidly. We're in our rehabilitation stage. So because of that, we're at about 90% occupancy, but we are getting the rents that were expected in terms of the improvements. And, it's just a matter of time before it stabilizes to that 95% we're expecting. So it's early stages, and, the economy is constantly changing with the news that's coming out, but we're feeling very confident in our value add strategy on that particular project.
So have you had to make any adjustments to your strategies?
So, we're moving forward with a lot of the capital renovations. The original plan was to go in there and kind of rehab about 40% of the units, and then kind of have like a 2-tier approach, like one scale that would kind of hit one tier of rentals, and then, a premium to see if that would kind of achieve even higher rental rates, and then offer that as kind of a package for a future investor on our disposition side. But right now, we're just kind of keeping the pace of our major renovations, working to increase those rental collections, and then mainstreaming our communication with our tenant base. So that's been the priority and focus right now.
Got it.
Yeah.
So what is the biggest mistake that you made, and what have you learned from that?
One thing about real estate is you're always going to encounter challenges no matter what. And that's kind of the nature of business in general. You're always going to run into some sort of unknown, and it's really how well you adapt to it and basically adapt to it. And then from there, make adjustments to not make that mistake again. So in terms of challenges that I've seen in the past, that I've experienced, is underestimating the rehab budget. And a lot of that challenge is like when you open up walls, things aren't to code at times. So you kind of start chasing, electrical wires, you chase plumbing, and you just try and do as much due diligence as possible. So vetting your entire tenant base, really trying to see what's behind the walls as much as possible, and being conservative on the underwriting is absolutely critical. So, from that aspect, making sure that you are trying to be conservative, especially in this particular environment, is what I'd recommend.
You mentioned San Antonio. This is that's my hometown. Obviously, we're in Hawaii now, but grew up there and whatnot. So I don't know if you've gotten a chance to visit. Obviously, I know you're on the West Coast, but
For sure.
If you put boots on the ground down there, how did you? What was the drive for to get down to that market?
I typically just fly out there. So.
Oh, no. Like what was what drew you to that? Yeah. Texas as a whole, I know has been a great spot, obviously for us too, because we have property down there too, but what drove the draw to San Antonio specifically to that market?
Yeah. So, ultimately, the supply and demand on a lot of these investments comes down to people. And, San Antonio, along with Dallas, Austin, Houston, been great from a population standpoint and a job growth standpoint. And because of that, these strong performing markets typically will weather recessions a little bit better. And it's a challenging market to get into to get the right kind of price point. So you really want to be integrated into that market. And once again, our operating partners really have deep connections out there. So they had gone through, thousands of units to, get to the point where they felt comfortable with what was going on in that market. And at the same time, the demographics spoke for the reason for choosing that area. So.
Awesome. Well, I know you mentioned you guys are still kind of in the, CapEx kind of, rehab stage for that particular one. Have you seen promising things so far with that particular project that would make you, hey, you know what? I think this is going to be a good market for us. We're going to continue to look for things here.
Yeah, we definitely have to be conservative right now in terms of all the estimations of rehabs and whatnot. But overall, our plan's kind of executing the way that we'd expect it to. So we're really excited about the fact that we're achieving our expected rental returns. We're able to lease up for the long-term contracts, which is really promising. But we're also just being very extra cautious to hold on to capital reserves. So we're postponing distributions primarily because we want to see how the things, how COVID plays out. And it's really about under promising, over returning is our objective here. So from that aspect, we're pleased with the progress, but we're also being very, very cautious on how we're approaching everything.
Sure. Yeah, understandably. So we've got a lot of question marks, right? Like everybody, a lot of people have been through the last downturn, but I don't think anybody else can say, the last pandemic. Yeah, no, we aced that one. We got a bunch of tools in the bag for that one.
Yeah. It's, a different recession altogether. The last one is really primarily based out around real estate. And this one is, a pandemic with a trade war, with an oil, standoff, and then, high corporate, credit debt. So there's some factors that come into play, and recessions are important for economies in general to kind of reset the value. So it's natural for this to occur. And then it's just being prepared and making sure your assets are being run really efficiently. You're cutting costs in the right areas to hopefully position yourself to kind of scale up when you come out of it.
You're talking about scaling up, and now I know you had mentioned the focus had been more on single family and kind of residential.
Yep.
How was the transition? What kind of spurred the move to the multifamily space? Besides, obviously the nuts and bolts, the structures, all that kind of stuff, and the experience that you've gotten, what drove the shift?
So really it comes down to the scalability factor and just working with higher level professionals across the board. And so I'm still running the residential turnkey operation, and I still have some brain damage with that. And there's still a strong need for it because honestly, commercial products are a little intimidating for new investors. So people who typically own their house, they kind of get warmed up to maybe a rental property or a fix and flip. And then, I recommend you kind of graduate into commercial to move your money a little bit faster. So that product class is one where there's value if you do it correctly. There's value in all the asset classes, but I love multifamily specifically for the reason because, institutional investments. So you're working with like large lenders who lend to you as a business, and it's, a non-recourse type loan. All the investors have to be accredited or sophisticated, which means, they've either have a net worth and they have some more sophistication in finance to, make good decisions on the investment. And then on top of it, that forced appreciation. So you have a lot more control and a lot more avenues to be able to increase the value of the property versus, a single family home is just kind of what the market dictates. So there is a myriad of reasons, and then the tax benefits, but because you're working with professionals across the board, professional investors, stronger lending, as well as larger companies, you can assemble teams and scale up a little bit faster.
For sure, yeah, I think that's definitely something that we've seen is the level of professionalism is definitely key,
Yep.
Especially when you go from that commercial or go from residential to commercial. Now, most of the turnkey properties, are those in Texas as well? Is that back in California, or where do you focus more of the turnkey?
Those are all in the suburbs of Chicago. So I'm
okay. Gotcha.
a 100% remote investor, born and raised here in LA, and I refuse to move out of this state despite the high taxes and the terrible traffic. But it's all about the people. At the end of the day, for me, family, friends, and relationships are some of the most important factors in my life. So all the people that I love are here in LA, and it takes a little bit of guts, but you can build great relationships out of state and assemble teams where people can apply and add their value to what you're trying to do. So that market's south suburbs of Chicago that I focus on a 5-mile radius out there, and great cash flow and product.
But wait, Kevin, are you sure that you're telling me it's okay to invest? I don't have to invest just where I'm at in my little neck of the woods. That's okay.
You better believe it. Yeah, I mean, for those who do live in cities that are up and coming with great demographics and great affordability, like you're in a sweet spot because you can build in your backyard. But a lot of the coastal cities, and island cities, may have some challenges with that value add strategy or affordability from the real estate standpoint. So it makes a lot of sense where you can utilize your equity in your house and then take out a loan at 4%, move that into an asset that performs at 8% with an upside 15. So that's kind of the arbitrage that a lot of us are doing here in real estate. We realize that different markets provide different benefits, and a lot of us in the multifamily space are really big on cash flow and adding value, which is the Southeast markets, some of the Midwest, Texas, Arizona. There's a lot of great cities out there where you can apply some of the strategy that we're talking about.
No, absolutely. Yeah, sign me up. That sounds awesome.
Great, man. I there's nothing wrong with like collecting passive income, because at the end of the day, you really have to just be honest with yourself and figure out like, what do I do best? And it is work in real estate. You have to wear a lot of hats and provide a lot of creative solutions. And sometimes it's just great to take the benefits, a slightly less return from the passive side, but still yielding a lot of the real estate benefits. So there is no right or wrong way to do it. Honestly, the only wrong thing to do is to not invest in general.
No, absolutely. Yeah, wholeheartedly agree with that. So for those of you listeners that are on the fence, thinking, gosh, can I make this work? Like everything around me is so expensive. You've got 3 guys literally on this call right now who have all made it happen and making it happen, at great distance,
Yep.
So you don't have to be able to buy something directly in your own neighborhood, as an investment property in order to start setting yourself for financial success in the future. So, hopefully the listeners can take away. I know a lot of our listeners, are already doing it, but, of course, there's always some of those that just have apprehension and, they have question marks, right? They're not sure if that can work. So,
yeah. And honestly, a lot of life comes down to mindset. And if you believe something, that will occur. Like it'll happen in your life. If you think it's too challenging, and if you think it's difficult or too expensive, like you'll manifest what you believe. So I'm an advocate that people should invest because diversification, having multiple streams of income, creates more security and more freedom and flexibility. And I think a lot of people in the real estate space just love the flexibility and income that you can generate from this avenue of investment. So.
Oh yeah, no, absolutely. Well, so coming back to, I know you mentioned earlier about being able to share and kind of give back. I know you have your group, the Multifamily Masters. Can you tell our audience a little bit more about what that's about and maybe how that came to be and kind of what they can expect to find as a part of that community?
Yeah, for sure. So I noticed the bio is a little outdated. We're actually at 7,500 members now. So should have corrected that one. But, it's been about 2 years. The original founder was Palchi, and met him at one of the Rod Khleif boot camps not too long ago. And, I really just resonated with his mindset of wanting to give back and build a community of like-minded individuals. So he started the first meetup, and then a handful of friends approached him, and we wanted to kind of expand the meetup group to be a little bit closer to where we were, because LA traffic sucks. So, we started off with his, then we expanded it to 3 total, and then, quickly blew up to 8 in Los Angeles. We got approached by other individuals in different states. So, now we're at 50 different meetup groups and 3 international. I think it's in Hong Kong and 1 in like Abu Dhabi or Dubai. And the reason why we grew so quickly was because of that community aspect. And it wasn't so much about taking, it's more so realizing in real estate, especially on bigger commercial deals, if you put together the right teams, you can create more value and tackle bigger deals. So, from that aspect, all of it was based on education, networking, and then, finding team members. So it was just a natural process where people really resonated with that no sales approach, education, and network. And, you hear the cliche all the time, your network is your net worth. And it truly does, manifest in a lot of different ways, where the higher level and higher quality people you interact with, you're able to create more value overall. So it's been a great journey, and it continues to be a fantastic journey. We've had one large conference last year. We had like 150 people at it. We were going to have another one this year, but got canceled because of, current pandemic situations. But we still hold virtual meetups at least once a week on various topics with different panel speakers. Everybody's on Zoom now. It's the new, it's the new way to meet people, and it's pretty awesome to be able to interact and learn from those across the country, where it maybe be difficult in a general conference or networking event. So I'm thankful to be able to give back as much as I can, and once again, just lend my experiences so that people don't have to do the same thing.
Yeah, I agree. That's actually one of the positives I've found from this whole thing, is that you're able to connect with people from all over the world so easily now, and it's become like the norm. It's just Zoom.
For sure. So. I mean, typically in LA, you're sitting in 20, 30 minutes of traffic to get somewhere. People's balance of life may have been thrown a little bit of a curveball with working at home with children and, all like getting used to that environment. But there'll be some silver linings through this entire process, and the ability to connect with people and hopefully nurture really powerful relationships that can, take you to where you're trying to go and bring your dreams into reality.
Right. So let's shift gears to our fire round. What is the best book that you recommend other than Rich Dad, Poor Dad?
So best book that I recommend business-wise or just in general?
Business.
Okay. So business book that I really love that kind of puts into place like structure for your business is Traction. I don't know if you guys have heard that one. And I have a bio background. I'm a, eclectic real estate and entrepreneurial background, but Traction really kind of helped put a framework around how to organize a company in a way that you can grow in it and put your goals into an actionable plan.
Yeah, definitely. Yeah, we need to implement some more of those strategies in Traction and for our company as well.
It's a process. It's a process.
Yeah. What is your superpower?
My superpower would be probably just caring and connecting with people. So I genuinely just want to help out as much as I can. So I really love to get deep and have those real conversations to see what's going on in that person's life, and can I help or provide any resources or value to them to just get them to where they're trying to go. And that's for me, business is people and life is people. So how can you make those connections or connect the dots and be as much of a resource as possible?
Yeah, that makes sense. For the working professional who's looking to achieve financial freedom, what advice or tips do you have?
I would say network. You definitely want to make sure you're networking and meeting people in that avenue. If it's real estate, there's a ton of free resources. I would say learn as much as you can, but then you have to take action, because it's too easy for people just to get caught up in that education bubble. And from there, I would say, make sure you put in the work and you stay focused, because it's not easy. I mean, I was working during lunch times. I was working at night in between sales appointments. I'd make phone calls to vendors. You have to have a little bit of hustle and grit to make your side hustle work.
So as we wrap this up, how can people reach out to you?
So I'm growing in the social media space. I really just want to be able to impact as many people as possible. And you can find me on LinkedIn, Kevin K. Dugan. You can go to my website, Altus IG, and that's ALTUSIG.com. Or you can find me on Instagram, same initials, Kevin K. Dugan. So.
All right, perfect. So it was great having you on the show.
Awesome, guys. I appreciate the time, and pleasure to hang out with you guys today.
Wow, what another amazing episode, Duke. What a great interview with Kevin over with Altus Investments. Kevin was showing us or telling us a little bit about his experience making the transition from working in as a real estate investor full-time from his W-2 job, and now moving into a space and an opportunity to provide others with not only education on how they can better their financial situation through real estate. And for him, it's single-family turnkey rentals, but also now into the multifamily space. It's a great starting point for everybody to get introduced into investing as a whole. He's a strong believer in diversification and making sure that everybody has that opportunity to create multiple income streams to better to better themselves and to have a greater impact both out in the community. He's a part of a fast-growing, exploding group, Multifamily Masters, where he said that they have 75,000 members globally, and how being able to tap into that knowledge base has allowed for explosive growth. And there's a hunger within the community, and we've seen it too, both here locally and nationally. So make sure that you're tapping into that. Make sure that you're seeking out that knowledge, making sure that you're plugging into groups just like either whether it be our group and you're here locally here in Hawaii, or wherever you are, wherever you happen to be located, there's always going to be like-minded individuals who want to better themselves, specifically through real estate investing. Make sure you go back and listen to the episode again. And great episode with Kevin.
And if you found value in this podcast, please subscribe so you can get the latest episodes. We would love it if you give us a rating and review on Apple Podcasts or Stitcher. If you know anyone who might resonate with today's podcast, please share the episode with them. And to connect with like-minded investors, join our Facebook group, Honolulu Multifamily and more. If you're interested in connecting with us, go to tricityequity.com to learn more. See you next time.